Welcome back. We're going to talk about the second objective in Chapter 6. It's a comparison of FIFO, LIFO, and weighted average based upon our example in objective number 1. Okay? All of the numbers that we're deriving were here in this example come from the shirt inventory from objective number 1. So if you want to flip back through your slides to that to see where the numbers came from, that would be fine. Under FIFO, LIFO, and weighted average, we came up with 3 different ending inventory numbers, 3 different gross profit numbers from our sample income statements. Okay? Ending inventory under FIFO was highest, as well as the gross profit. Okay? So what we can say from our example where we had shirts in inventory at $10 and they rose to $12 on subsequent purchases was that in periods of rising prices under FIFO, it will produce the largest ending inventory, whereby LIFO produces the lowest ending inventory costs. In periods of rising prices, the gross profit is highest under FIFO, lowest under LIFO. So you can see by using FIFO and LIFO, you can manipulate what your profits are going to be and what costs remain on the balance sheet. And of course, an average method is a combination of the two, whereby it gives you somewhere in between. Slide 19. Under the weighted average, what's the advantage? It smooths out price changes for inventory. Okay? You'll see that the inventory average is given as $45, back on slide 18. The advantage of FIFO, its ending inventory approximates the current replacement costs. Think about that. Its ending inventory approximates the current replacement costs. Why so? Well, the most recent costs are left on the balance sheet. That's why it approximates the replacement cost. Okay? So that's an advantage of FIFO. If we had to replace all our inventory today under FIFO, we would get a good representation from looking what is actually there in ending inventory. Under the last in, first out method, also known as LIFO, it's a better matching of current costs and costs of goods sold with revenues. Why? Because the most recent inventory costs are transferred from inventory to cost of goods sold under LIFO. So that's considered by accountants to be a better match of current expenses, cost of goods sold, with current revenues. So, in practice, what method do we use the most? Well, FIFO is the most popular at 46%, followed by LIFO, followed by weighted average at 20%, and then approximately 3% use some other type of method, probably most closely associated with specific identification. Next, we're going to walk through an example using all 3 types of inventory methods. So why don't you flip in your textbook over to page 335. Okay, and we're going to be dealing with number 1, 613, on page 335, the Hyatt Magic Company. We're going to be measuring ending inventory and cost of goods sold through a perpetual system, starting off with FIFO.